So we talk about ships, we talk about money as well, and I would like to welcome you to the panel that is going to discuss capital markets and shipping. Capital markets have shown revival for shipping lately, so we look forward to a panel of experts who are going to share their insight with us. I'd like also to thank, obviously, Christa. I'd like to thank all the panelists, Jim, Larry, Chris, but I'd like to thank Christa in particular, who is the partner for this particular event, for her help, sharing the heavy burden of the event. So thank you very much. And Keith, thank you for moderating this panel. I will turn it over to you. Again, thank you to everybody for being with us.
Super. We have a great panel for everyone today. We have 4 bankers with us who are among the most active in the shipping space. We work with all of them regularly on all of our capital markets transactions. And I'm excited for a great panel here today. We have Christa Volpicelli, who's the Managing Director and Head of Global Transportation at Citi. We have Jim Cirenza, who's a Managing Director at D&B. We have Larry Glassberg, who's a Partner and Senior Managing Director at Maxim. And we have Chris Weyers, Managing Director and Head of Maritime Investment Banking at Stifel. So we'll jump right into it. The markets, as you all know, have been very hot and very resilient. Deals in the shipping space, have been getting done. And so I want to get the views of our panelists, just to discuss the markets generally and how shipping fits into that. So maybe we could start off with Christa, and you could give us your views on where the markets are today.
Sure, happy to do so. Thanks, Keith, and happy to be here with this group of colleagues from other firms. So I guess with respect to the markets generally, when you look across the capital markets broadly, not just shipping, it has been just a tremendous last 12 months of activity, really accelerating in 2020 and continuing that pace in 2021. It's hard to believe that we're sitting here at the beginning of March. The first month has really just been a bit of a blur in terms of how busy all of us have been. Equity markets remain robust, trading at very enthusiastic levels. A lot of activity is happening in sectors such as energy transition, sectors such as SPACs. But as Nicholas commented in his opening, we saw the first shipping IPO in 6 years. We brought to market for ZIM in the U.S. markets. So equity markets have continued to be supportive. Convertible bond markets, 2020 was a record year for convertible bond market issuance in the US, and it's a market that can be quite appropriate and attractive for some of the larger shipping companies which are listed. High yield bond markets continue to be strong. The Citi high yield index is trading at a bit above 4%, which is a 25-year low in terms of overall levels. So that is supporting robust issuance. So, as general speaking, all of our capital markets desks are just increasingly busy. When you think about shipping's place in all of that, I would say 2020 was certainly a challenging year in terms of valuations. You saw valuations down 50% in tankers and dry bulk, a little bit less in sectors such as LNG, down 20 to 30%. You saw significant outperformance by the liners. So it was a difficult year in terms of backdrop and valuations. We started off 2020 a bit better in terms of many shipping sectors kind of being up 10 to 30%, depending on the company, depending on the sector. And so, it does feel like a time where, there could be a more supportive backdrop for shipping in 2021. I think it's very nuanced and very situation specific, in particular, because of all the attention that is being given to other sectors within the market. I think some of the themes that we have talked about in past years in terms of what makes a shipping equity attractive to investors are still the same. And I'm sure we'll talk about that later in the panels, but certainly the overall backdrop is supportive. And really, I think it comes down to the individual corporate level in terms of where our valuations, does it make sense to be accessing new capital? This is a cyclical industry. And so, one thing we all know is it's more beneficial to be raising capital when you don't need it out of a period of strength. But still a lot of focus on balance sheet liquidity and proactively managing capital structures is a theme we're also hearing.
Chris, anything to add to that?
Yeah, let me comment first of all. I mean, last year broke records in terms of issuance of investment grade, considering a couple of months of the year where the market was closed to high yield and equity. It's incredible how much paper came out. If you look at the last 6 months of the year, as it relates to Europe, Norway and Sweden represented probably half of all the issuance out of Europe. And the equity market in general has just had an incredible tear now for the last 3 months. And if you want to point out a 2-week stretch that just shows how vibrant these markets have become, in the first 2 weeks of February, there were 186 IPOs, SPACs, and follow-on offerings priced in the US market. Obviously, both of those weeks, each on their own, broke a record. The amount of paper coming to the market has surpassed the levels of share buybacks, and that's only happened a couple times in the last 20 years. So the issuance is phenomenal. Cash levels among institutions are getting a little bit lower. People are getting to the point where they might need to sell some things to buy some things, but shipping has certainly found its way into the capital markets. Certainly the dry bulk sector, the container sector, the cruise sector, both in terms of equity, convertible bond, and debt offerings. And I'm thrilled to see that the evolution of the green bond market has finally embraced shipping, and we can talk about that a little bit more later.
Keith, I would say is, and I think Christa pointed to this a little bit, a lot of it is going to be situation specific. I think in the shipping markets today, I think there's a very big bifurcation between small cap and kind of maybe the larger small cap companies that are public, because, at the end of the day, most of the shipping companies are still small cap companies to a certain extent. We're like all of our colleagues that are on the panel today, volumes, risk is a bit on the table. And I don't think I've seen as much risk on the table in the 20 years that I've been doing this, but in particular on the shipping side, because we've done 35 equity deals within the space since the beginning of last year. We've seen active institutional investment coming into the transactions that we led. All the deals that we did last year and this year, 35 were all lead managed transactions. Institutional interest has picked up as well as retail, and retail through our platform, as well as other investors within the market. But I would tell you is in the last 6 months in particular in the dry bulk market, a number of the deals that we've done, sizing as well as valuations have increased. And we actually did a transaction about 2 to 3 weeks ago, which was a $75 million follow-on for a dry bulk company. And the pricing of that was probably one of the most accretive places in equity financing has gotten done in the market in the last 5 to 10 years for a maritime company. So there is risk on the table. There is a lot of demand, and that's coming both from the institutional side as well as the retail side, broad-based, not just shipping, pretty much every single sector out there in the equity markets today.
Chris, anything to add to what the others have said?
Yeah, so I'll just add, at Stifel, we focus pretty much entirely on the middle market. Like, we're a diversified middle market investment bank. So, we cover essentially all industries, not just marine. And last year in the middle market, it was, the busiest year we've ever had. And it was particularly busy from an equity capital markets perspective, but the debt capital markets were shockingly busy as well. When I try to call the capital market bankers, to get them to focus on different opportunities, they've literally never been busier. They're doing like a new SPAC IPO, it seems like every week. They're de-SPACing a SPAC every week. The technology and biotech space is doing great. If I look back at 2020, I'd agree with what, Christa and the other panelists said. I think it was the slowest year I can remember for, commodity shipping. As it related to the capital markets, there was very, very little activity. But as we've kind of moved into 2021, activity's picked up a lot. I know Larry's talked about, some of the equity offerings his company's done. We haven't done any equity offerings, public equity offerings yet this year for shipping companies, but I know Christa's bank got the IPO done for Zim, which is great. And the trading activity that we've been doing amongst the shipping stocks, particularly in dry bulk, but also in tankers and containers, has been the highest it's been for years. And there's a lot of big, quality institutions that have been on the sidelines for a number of years that, we've been spending a lot of time, working with either in banking or in research and sales that are spending time in shipping. And we're seeing them starting to buy stocks in shipping. These are guys like Fidelity and Wellington and, a lot of the big, quality names that have been on the sidelines for a lot of years. So I think we're going to see a big capital markets year, develop in 2021. And I suspect it'll get better in 2022, because I think that's when we're really going to see the shipping markets get better.
We'll come back to the IPOs in a minute, but I want to kind of dig in a little bit to the types of transactions that you guys have been working on in the shipping space. Larry alluded to a bifurcation in the market. Maybe you could speak specifically to how companies are actually raising money, what the specific transactions they're doing, and are they happening in certain sectors or in certain size companies? Larry, maybe you want to start us out on that.
Yeah, listen, I think, sector-wise, we've been doing deals in pretty much across the board in the three major verticals: tankers, dry bulk, and container side. Last year, again, we did about 31 transactions in a combination of registered directs, confidential and market and public offerings, ATMs. And this year we've done 4 follow-on offerings on the equity side within the space. So I think we've been the most active in the market by many folds on the equity side in the shipping space. And again, I think a little bit of that is the bifurcation in terms of sizing and also deal size in the market. So a lot of the companies that we are focusing on are the sub $500 million market cap companies. And in particular, in the smaller size shipping companies, liquidity has picked up dramatically within the market. And I think what's aiding in a lot of the capital raising that's going on, especially in the secondary markets from a secondary point of view or a follow-on point of view, is really the liquidity profile of those companies. And I think liquidity is enhancing, one, the type of buyers that are coming into the store, both retail and institutional, two, the sizing of deals that are getting done. So we did a $75 million follow-on for a company about 2 to 3 weeks ago. That was up from a $30 million deal that we did for another company a week before that, versus some of the sizings of deals that we're doing last year were $15 to $25 million in sizing. So risk across the table, again, is back. I think liquidity is driving a lot of demand from the investors. I would tell you is the $75 million follow-on that we did for Cirenza, which is a dry bulk company focused on the Capesize market. That was a deal that had 20 plus institutions that were coming into that transaction. So very active institutional market that is coming back into the names. And we are seeing retail demand, because we do have a large retail distribution platform ourselves, coming into a lot of the transactions that we're doing from an underwritten point of view. But again, liquidity is driving, I think, a lot of demand in names today.
Jim, DNB sits in an interesting spot. You sort of straddle both Norway and here in the U.S. What types of transactions have you guys been focused on?
I'll start with the plain vanilla stuff first. It's been maybe our most active stretch in terms of ATM activity, because share prices in a few segments have been better and volumes have been substantially better. We just did a $300 million plus equity raise for Golden Ocean 2 weeks ago. But to me, the big breakthrough this year is the sustainability linked bonds. So it's been very difficult in the past, when you think about how the green bond market has evolved in the last decade. It's been very difficult in the past for carbon heavy industries even if there's a transition to get to be less carbon heavy, to utilize these markets, and their cost of capital was substantially higher. And shipping has had a very difficult time. You know, we did several years ago a green bond, although the newspapers called it a gray bond for TK Offshore. But this year, January, February, we raised $200 million for C-SPAN in a sustainability-linked bond, and we raised over $100 million for Ogfeld in a sustainability bond. And if you were to talk to those companies, I think one of those companies would tell you we got a better price with a sustainability bond than we would have with a straight bond. And the other company would tell you we were able to upsize our offering by a third, and we probably wouldn't have had access to raise that kind of money had we not had a sustainability linked bond. And so when you talk to companies like Sustainalytics, which have among the third party, vendors that have opinions and advise companies and advise investors, their perspective is we need to have KPIs that are relevant, but also targets that are ambitious enough. And, what's the right approach to setting targets that's reasonable for a shipping company? But it's great to see the evolution of the green bond market end up with these sustainability targets that impact, greater investor access, impact pricing, and impact these companies' behaviors going forward. Because now that they've issued the money, if they want their coupons to be as low as they possibly can be, they have to hit the targets they've laid out.
Chris, anything to add? Chris, I think you're on mute.
Sorry, and the question's anything to add on on green financing, right? And crossovers between Norway and the U.S.
You can answer that, or if there's any specific transactions you want to talk about, that works well too.
Yeah, so we don't really do a lot of financings in Norway, but we have worked together with DNB on a few financings in the U.S. So I guess from my perspective, we hear a lot about green finance. I know the new CEO of Citi is talking about green finance a lot, and I know the European banks have been talking about green finance for years. It's getting much more serious in the United States than I've ever seen it before. I still have not seen a green finance deal get done in the U.S. But we're spending a lot of time now, looking at like offshore wind in the U.S. that we never looked at before, looking at various renewables. Investors that we talk to on the private equity side are very focused on kind of investing in green companies. So it's definitely, I'd say, coming very quickly into the U.S. market, this focus on green. We just don't have the subsidies today that, I know a lot of the European governments are offering that, effectively, drive a lot of those green bonds in Europe. But we'll see what happens now that we got Democrats and, all both the House and the presidency.
So Christa, I want to give you an opportunity if there's anything you wanted to add on specific transactions that you're seeing, but I also wanted to come back to the ZIM IPO, which you had referenced initially. The IPO market in shipping, when you were handling ZIM, is this a case of a company that was able to differentiate itself in the marketplace, take advantage of an opportunistic period in container shipping in their sector, and was able to do an IPO, or is this part of a broader trend that we're going to be able to see in shipping, and will you see spill over into other sectors, going forward?
It's a good question. I would not characterize the ZIM IPO as opportunistic, because the container market is hot. I would describe that IPO as a long-term evolution of the company's strategy in terms of establishing itself in liquidity for its own shareholders. And And look, I think that for too long, there's been a view around, IPOs in this sector that, they can be, very opportunistic. When there's a hot market, you see companies kind of rush to try to bring a business public. And there's a reason why you haven't seen more IPOs in shipping in the last 5 or 6 years. And that's because I do think that the bar is higher. And, the question of should a company be public or private, there's a lot of, I think, reflection a company has to do in terms of what's the right strategy for a specific management teams. I think that in terms of, where are we focused today in terms of what are the kinds of transactions that, we have done and you'll see us doing. I think one aspect that I think is unique about Citi, I mean, we are a global international investment bank, but with a very specialty focus around shipping. And, we've got team members in New York, in Hong Kong, in London, in Oslo, and, we have specialists on the product side in all of those markets. You don't see Citi play in the OTC markets in Oslo, but we actually have a dedicated distribution sales force within the region. And so when we are working with our clients, we are looking at marketing offerings globally. Shipping is an international industry, and so different markets can be more appropriate at different points in time, and depending on the size of the company and how much capital they're trying to raise, there's different depth in certain markets. And so we play in most of those markets, and so I really think that it's hard to characterize a one-size-fits-all topic. To pick up on Jim's comments in terms of the trends of ESG, it's absolutely an increasing area of focus for us. We have a very specific group within Citi that we call our Sustainability and Corporate Transitions group that is very much focused on ESG trends and themes across the equity markets, the debt markets, working with clients. Many shipping companies have published, their sustainability reports, and there's different degrees of ESG in the capital markets. There's specific financings, as you talk about green bonds, but there's also just a general, more focused level attention that we are definitely seeing all investors pay to shipping in terms of how are they managing their ESG agenda. And so even if it's not a green specific financing, we are finding that as we think about selling different stories or selling different equity or debt to investors, it's an important part of the narrative.
We'll come back to ESG in a second. Just to continue with the theme, with IPOs, Larry, your firm is very big in the SPAC world. For those people who in the conference that don't know what a SPAC is, it's a shell company that goes out and does an IPO. The proceeds are put in a trust. Then, the company has about 2 years to go look for an acquisition target, and it's a means of doing an M&A target on the back end to go public. As share prices tick up for shipping companies, are we going to start seeing SPACs in the shipping space? We haven't seen any yet. They've been, dominating the capital markets recently. I think it's now, I saw a flash that it's a $700 billion industry, taking half of all capital markets transactions. Is this something that we're going to see as shipping companies to be targets, or will operating companies actually sponsor them themselves?
Well, it's funny because there probably isn't a day that doesn't go by where I'm getting reached out by a ship owner or someone in and around the shipping space about a shipping SPAC and or a direct IPO. So I think in the last week, I probably had 10 to 15 conversations around SPAC issuance for specifically related to shipping and or IPOs just generally in the market. From a historical point of view, as Maxim's been involved about 30% of every SPAC to come to market as an underwriter, co-manager, or syndicate member since early 2000s, and we've probably been involved with north of 50% of all the shipping deals that have come out, from a SPAC point of view too, as well, both from an issuer point of view as well as on the M&A front. Until I think we start seeing really sustained valuations of companies trading significantly above NAV. I think both the IPO market as well as the SPAC market is going to be challenged to be able to get deals done and really received well from a market point of view. And the challenge, you know, with SPACs and to a certain extent, as well as from an IPO market is, you know, ship owners, you know, are very focused on NAV and from a valuation point of view. And public market investors, if you're going to probably buy the security in a de-SPACing, there's going to have to be a very big public to private arbitrage between NAV and where you can create a company by taking that company in at either an NAV or a discount to NAV and have the stock trade up, say for argument's sake, NAV is 1.3 times in the public markets, to create a return, not only to get over the promote in the embedded dilution in the SPAC structure, but also to have the stock be able to trade up to give investors a return not too dissimilar from an IPO point of view. So there are definitely a lot of people that are tiptoeing around it. The challenge in some cases for people that want to go out and create a new SPAC today is there are, you know, let's call it 365 SPACs that are out there looking for transactions or targets today. And a lot of those existing SPACs can easily change their focus or sector focus to go after shipping if they wanted to. So, you know, listen, I think there are going to be shipping SPACs that are coming out. I can't tell you if we have any in the pipeline, but you will see a lot of activity coming out. It's really just going to come around is there sustainable valuation arbitrage spreads for people to be successful with being able to de-SPAC.
So just going back to the ESG point that we were making before, you know, investors really see climate risk as investing risk. Shipping companies, you know, are the most efficient way to move goods on the planet. They've adopted many government regulations to limit greenhouse gases. They're taking steps to evolve in new propulsion for engines. As far as investors go, and as far as the E and ESG, with shipping companies, is this more of a investor education issue where they need to sort of teach investors about all of the green efforts that shipping companies are involved with? Or do shipping companies need to fundamentally do anything different to appeal more to the investing public as, you know, we move into this era of decarbonization and going green? Maybe I'll start with Chris. Chris,
actually, let me take this one because sure. I was on a panel last week with Sustainalytics, and so I'll give you their stats. Shipping, if they don't adopt stricter sustainability targets, will go from 3% of our planet's carbon emissions now to 17% of our carbon emissions in 30 years' time. The efforts that other industries are making are far greater on average than the efforts that the shipping industry on average is making. So, you know, January 2020, congratulations, important step. Poseidon Principles, congratulations, important step. But the world is evolving and shipping needs to evolve faster. Sorry to interrupt.
Chris, anything to add to that?
Christa or Chris?
I was asking Chris Weyers.
Okay, Chris.
You can go next, Christa.
Oh, sure. Thanks, Keith. You're a little bit hard to hear, Keith.
I'm sorry.
But so yeah, I know I talked about it a little bit before. So I mean, shipping is generally a group of followers as it relates to things like, you know, carbon. And they really kind of need to stay followers because it's a commodity space and they're not going to get reimbursed for, you know, capital expenditures to, you know, reduce carbon emissions if their customers aren't willing to pay them for those expenses. So, I mean, there's global regulations that are going into place that, you know, are requiring a reduction in carbon emissions of, I don't know the exact stats, but I think a 50% reduction in carbon emissions by either 2040 or 2050. So shipping's definitely like headed in the direction of, you know, trying to emit less carbon and be more green. But as all the ship owners we work with will tell you, in order to do that, we have to identify a new propulsion system for shipping. Like, you can't use oil. to fuel these engines. And it's a huge infrastructure issue around the world to figure out, what that new fuel is. I think a lot of people seem to be triangulating around hydrogen, but, at this point, there's little to no hydrogen available. And until we get, massive kind of green energy generation sources online, it costs a lot of money to make the hydrogen. So it's not economically feasible to use that today as a fuel source. So there's definitely a lot of pressure amongst investors and companies, I think, to figure out a solution. And, I'd love to know what it is, but I don't personally think the solution's necessarily going to come from the ship owners. I think we need the Shells and the Exxons and the Maersks and the Walmarts, essentially, to work together and help the global community figure out what our new propulsion system is going to be for ships.
Christa, anything to add to that?
Sure. I agree with Chris's commentary that there's broader industry forces here, and it doesn't come down to any one individual ship owner in terms of affecting this change. I think when it comes down to the question of how do you raise capital in the face of a focus on ESG and all of this transition and all of these pressures, I think it comes down to, working with your banks, working with your advisors to identify the right investor targeting. There are some investors out there who will put a bright line in the sand and say, I'm making an institutional decision not to invest in something that touches oil. And no matter what a tanker company does, they're not going to change that view. So you can be wasting your time talking to that investor. There's many more investors who are taking the approach of, I want to support a company within a certain industry that is being part of affecting change and is, making investments to transform their fleets, that is, becoming part of these initiatives. And so I think within the shipping sector, we have to acknowledge where we are. We have to acknowledge that there are limitations, and we're increasingly being very focused around investor targeting, so that when we're raising capital, whether it's on the equity or the debt side, we're focused on the investors who can embrace, what that particular shipping company can actually offer with respect to talking about these things. But again, it also comes down to, I think on the company side, management teams are actively thinking much more about how they make sure that they highlight all the initiatives that they have to investors, where, 2 years ago, it wasn't the case that these things were being highlighted to investors. Many of the companies in the space are doing a lot of great things that we need to make sure investors understand.
So as far as positioning goes with respect to shipping companies, a lot of them have been earning money. They have cash on their balance sheets. What do shipping companies need to do to make themselves the most attractive to investors? Is it share buybacks? Is it dividends? Is it growing the fleet? What makes a shipping company in this environment, most attractive to investors, and what should they be doing? Larry, do you want to start with this one?
Yeah, listen, I think it depends on where you kind of are in the value chain. I think there's a lot of, we've come through a time period where a lot of the shipping companies have gone through restructurings and a deleveraging of the balance sheet. I think there are probably some fundamental, conceptual ideas that we have to talk through from a capital markets point of view of what works in the shipping world, right? Does 50% leverage work? Does 80% leverage work? Does no leverage work, right? I think this is all evolving as a condition to what has come from the past for the development of the capital market. Some of those stories have worked, some of those stories have not worked. And obviously, if you're a $1 billion, $2 billion market cap, that's going to be a very different story than someone that's a $100 to $200 million market cap, because you can get growth of your fleet very rapidly with a smaller market cap company or a smaller fleet from a growth point of view. I would say, as most of the companies that we are working with today came through some type of deleveraging effect, are now, have a fair amount of equity on the balance sheet through capital raising, and are really going into growth mode, right? They're seeing great opportunities for acquisitions. They think they're buying at the right pricing. They've upticked on where they've entered the market on certain assets over a short period of time, and they're looking to deploy more capital. to enhance the value of their fleet. So today, I would say the investors that are coming into our transactions are seeing rapid growth of the fleet sizes of the businesses, stories that are not over levered or moderately levered in some situations, and ultimately have volatility with the underlying asset price as well as kind of rates within the market. So a lot of the companies that we're working with today are not fixed. They're more running on spot to a certain extent. And as rates start to pick up, I think you'll see cash flows picking up, as well as underlying equity values as the business starts to grow pretty rapidly.
Chris Weyers, anything to add to that?
Yeah, so I mean, from my perspective, with what we're seeing, you know, there are like real targets that I think public companies need to, you know, reach in order to be interesting to institutional investors. So, number one thing that we hear is, you know, good corporate governance. A lot of, I'd say, most of the bigger public shipping companies today have good corporate governance in place. And I think if you want to become a big, you know, market cap shipping company with a broad, you know, institutional ownership base, it's critical to have good governance in place, and, you know, and make it clear to investors that, you know, you're thinking about them first, you know, not management teams or, you know, or you know, related party managers. So that's, you know, really key number one. Key number two is low, in my opinion, is low leverage. I mean, companies with high leverage, assuming, you know, the market thinks, you know, values of their ships are going to go higher in the short term, theoretically can raise money, but those sorts of companies are, you know, typically end up going through restructurings. I think there's been a huge deleveraging of the industry over the last, you know, several years. We've gone through a crisis, you know, over COVID, and I don't think we've seen any shipping bankruptcies. That wasn't the case at all around the financial crisis. So low leverage is really key. And then I think, you know, companies, you know, for commodity shipping companies, they you know, if your shares are valued meaningfully below your NAV, you need to be buying back shares. You need to be paying dividends. You need to be paying down debt. You should not be buying assets unless you use shares. And when your shares are at NAV or below above NAV, that's when you should be taking advantage of, you know, using cash for acquisitions and raising capital. And the markets have gotten pretty smart. So, you know, it's very hard to raise money above NAV for public shipping companies. So when they trade above NAV, typically they do an equity offering and they get it done around NAV. So I think those sorts of models, you know, work, and that's what we got to focus on. And hopefully shipping companies can find a way to consistently trade above NAV, because we're also seeing a lot of going private activity, as I'm sure everybody's aware of. You know, Seacor's announced it going private, Gaslog Limited's announced it going private. You know, we've been working on some going private transactions. So I think some of these companies, you know, that for whatever reason can't get valued properly in the public markets, even doing the right thing, you know, need to evaluate, you know, alternatives to go private.
So we only have 2 minutes left here. Maybe we could just go around the horn really quick, and then you could all give us your final thoughts. Christa, what would you like to leave us with?
I guess final thoughts would just be maybe going back to where we started, which is 2020 was really just an unprecedented backdrop in terms of the forces of change, in terms of socially, politically, economically, the pandemic. And really, I think it's accelerated a lot of trends that were already underlying in terms of energy transition, consolidation, how companies are thinking about balance sheet. And so, you know, the broad markets are supportive. There's a lot of capital being raised, and within the shipping sector, there will be capital there. It all comes down to the specific situation of how an individual company has a strategy to deliver value for those shareholders over time. There's, you know, a lot of companies competing for capital. We think there's capital there for shipping, and there's a good backdrop to support it. But it all comes down to the individual story of the management team.
Jim, 20 seconds.
Sure. Listen, I think there's some great examples in the last 2 years of companies that clearly show they care about their share price. You look at the tanker space last year with companies like Euronav buying back shares, or in the LPG space with Dorian buying back shares. You've had a decade where the S&P quadrupled and the shipping stocks on average halved. And so it's good to see the kinds of examples we're seeing in terms of share buybacks, dividends, taking companies private, showing that you care about your share price.
Larry?
Markets are euphoric, markets are active. And as an issuer coming into the market, you want to take advantage of that. Capital is flowing, and having done 35 deals within the space in the last, let's call it 14 months, take advantage of it while you can, because there will be a reckoning, and you want to have a very strong balance sheet when that reckoning comes, to be in a position to potentially pick off other assets or to be able to support the ups and downs of the market.
Yeah, I'll just add, I guess my last comments is, I think there's incredible value in the marine markets right now, especially when you look at, how much values increased in other sectors outside of marine, and marine really hasn't benefited at all from the great capital market situation we're in. So I think there's great value. I think investors are going to realize that there's great value, and I think we're going to see companies' share prices trade up considerably this year and hopefully become more attractive candidates for raising equity capital.
I just want to thank all of our panelists. Nick, thank you for having us.
Thank you. Thank you for being with us. That has been a great panel, great insight. Thank you so much to all of you. Thank you.
Thank you, everyone.